Today, I want to talk about how the DTCC has been selling insider information to short sellers. I want to explain how this has been keeping these short sellers afloat, but how it's all about to come crashing down for them. So stay tuned and let's make some money. And now I'll dive straight in with the key information. So, Unusual Whales has tweeted saying breaking news. The DTCC is leaking sensitive trading data. But not only that, they're selling data that sophisticated traders can use to profit at the expense of more traditional retail investors. Now, this isn't just some trust me bro information, this comes directly from a Wall Street Journal article. It says an insider report from an institutional brokerage says the DTCC is selling data that sophisticated traders can use to profit from retail investors. It says the DTCC is leaking sensitive trading data via two little-known data feeds. Now, the DTCC has obviously disputed that report by saying we categorically reject any claim that our data products reveal or could be used to reveal confidential information. It says Mr. Hegde said the DTCC's feeds anonymise the firms and individuals doing the trading, provided only aggregated data across many transactions, and came out with a delay. But still, a number of money managers have said they're worried about harmful impacts from the two data feeds, called Equity Kinetics and Investor Kinetics. They said it seems inappropriate that the information that we must provide to settle trades is repurposed in a manner that directly harms our clients. And the DTCC's financial statements even show that in 2022, its revenues from data-related services grew 15% to $56 million. And this data that's being sold, all these data feeds, can be used as inputs for computerized trading strategies, aka high-frequency trading firms. Now you may be asking, saying, Tom, who exactly is buying this data from the DTCC? Is it anyone nefarious? Well, I think to get a good idea of who exactly is buying this data, we should look to the largest and most trusted DTCC customer. Which customer was the very first to clear both a treasury and repurchase agreement through the new DTCC platform? Well, you guessed it, it's none other than Citadel Securities. Back in 2019, this article said that Citadel last month became the first firm to clear both a treasury and repo agreement through a new DTCC platform. Clearly, Citadel are so favoured by the DTCC, they even use Citadel to demo new trading platforms and new products. So if they use Citadel to demo and trial new products, it wouldn't surprise me if Citadel was also the very first customer of this data the DTCC is selling. Especially because we know that Citadel does use algorithms and high-frequency trading practice to take advantage of retail investors. Now, obviously, I'm sure there's no surprise that I think this is completely and ridiculously illegal. But it's good to see that it's not just retail investors like me that think this is wrong, but it is actually good to see that some other hedge funds out there are thinking the DTCC is clearly overstepping the mark. They've obviously realised that these large hedge funds like Citadel buying this data from the DTCC aren't just profiting off of retail investors, but they're also profiting off of other hedge funds out there as well. And that's why some of these hedge funds are now standing up and exposing this in the public eye, sending it straight to the mainstream media news places. And I imagine that considering this has been released from the mainstream media news, I imagine what's actually going on is even more sinister than the Wall Street Journal is making out. I believe this is something that's obviously going to be seen in the Wall Street Journal and picked up by other senators that are going to end up discussing this in the Senate, at the Fed and at the White House. And I do hope it leads to a massive clampdown on these hedge funds like Citadel Securities. Now, why exactly is this a big deal, and how exactly has this been keeping short sellers afloat? Guys, be sure to sign up to Moon, the sponsor of today's video, by signing up using the link in the description below. You can currently receive up to a whopping 15 free shares, entirely commission-free trading, free level 2 market data, and most importantly of all, Moomy is very easy to use, it's very clear and concise. Well, recently SEC Chairman Gary Gensler said that many hedge funds are receiving the vast majority of their repo financing in the non-centrally cleared market, where haircuts or initial margin requirements are not necessarily applied. But he added saying this might create greater risk in times of stress, especially when non-centrally cleared markets start applying these haircuts and discounts. Basically, these haircuts where we've seen bonds valued at zero for margin purposes, where we've seen bank stocks valued at zero for margin purposes as well, and when we've seen equities below a certain price point receiving a massive haircut, none of this has been impacting these short selling hedge funds. And that's because these hedge funds are effectively meeting their requirements through over-the-counter repo agreements instead of through centrally cleared repo agreements. During these over-the-counter trades, they've obviously not been applying these haircuts, and that's why they haven't failed these margin requirements so far. But as soon as some kind of event, which I'm going to touch on in a second, happens, it will force these over-the-counter agreements and over-the-counter lenders to start applying haircuts OTC as well. Frank added, saying, "So Gary's telling me that hedge funds haven't even felt these haircuts over the last 2 years." And he said that's huge because we've had at least 3 major haircuts for collateral in that time period. So far, these collateral changes haven't impacted these hedge funds. But what happens when all 3 of these collateral changes and all 3 of these haircuts impact all of these hedge funds at the exact same time? What on earth are they going to pay with? So it's likely that as soon as this big event happens, even these OTC lenders are going to start enforcing haircuts and enforcing these margin calls. And Unusual Wells has tweeted saying the FDIC is reportedly going to make an announcement on the Deposit Insurance Fund today. Now we know that since the collapse of Silicon Valley Bank and Signature Bank and First Republic after that, the value of cash held in this Deposit Insurance Fund has been reduced dramatically. I think at the start there was something over like $400 or $600 billion, but this has now been dwindled down to below $50 billion. They basically cannot support not even one more bank failure. And Stanimir believes that he already knows what this FDIC announcement is. He tweeted saying, according to the FDIC Corporation, there was $620 billion of such unrealized losses sitting on US bank balance sheets in early March. However, recent estimates have suggested that that loss has increased to nearly $1.7 trillion. If these banks really do have $1.7 trillion in unrealized losses sitting on their balance sheet, it wouldn't surprise me if some of these lenders start enforcing haircuts and margin calls through their OTC lending desks. Which is basically going to mean that all of these hedge funds that were just about meeting margin requirements without those haircuts are all of a sudden going to take a massive haircut, fail those requirements and receive a margin call and end up being liquidated. And that's why we're already seeing some hedge funds like SoftBank's Vision Fund reporting an annual loss of $32 billion, the biggest loss in their entire history. It wouldn't surprise me if we start seeing many more hedge funds coming out with giant losses just like this in the next few weeks. Now, I also saw something very, very interesting, which is this tweet from Guardian. He tweeted saying, read this. According to Adam Aaron, there should be approximately 140 million shares after the reverse split. Now with 3.8 million shareholders, that would be an average of each shareholder holding just 37 shares each. He said, do you really believe the average shareholding for AMC shareholders will be just 37 shares? Many users are obviously replying to this saying that they hold many multiples of just 37 shares, with some users holding 100 times that. And that's why I've been saying that we need to obtain this full list of shareholders as seen in the Bed Bath & Beyond bankruptcy lawsuit. I'm not actually sure where this full list of shareholders actually comes from, as it obviously shows Seed & Co as an individual shareholder. I don't know whether it comes from the DTCC or whether it comes from a source higher up. But what I do know is that we need to obtain that same list of shareholders for AMC and prove it in court, because that way there's absolute proof of the float being sold multiple times over, and then Adam Aaron would be free to speak on it. As Judge Gibson has tweeted, he said the only people that knew the true share count picked the perfect time to lock the QSIP down by entering Chapter 11 bankruptcy. He said it was no mistake for the judge to list all shareholders above 4.5%, and when the list goes public, the fun begins. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell, because that way you'll be alerted when I upload a new video. Cheers!